Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today our guest, my friend, Paul Moore. Thanks for being on the show, Paul.
Hey, it's great to be here again, Whitney. Thanks for having me on. It's an honor.
Yeah, I'm pleased to have Paul back. He was a recent guest. You've probably heard him on the show. Then you've also seen him all over Bigger Pockets. He's doing lots of videos and writings and stuff for them as well. But Paul is the founder and managing director at Wellings Capital. He's the author of The Perfect Investment, Create Enduring Wealth from Historic Shift to Multifamily Housing. That was in 2016. Paul co-hosts a wealth building podcast called How to Lose Money. And as I said, he's a writer for Bigger Pockets, and just he's been an entrepreneur for many, many years, a great friend of mine for many years. And Paul, I'd like for listeners to go back and listen to the other show to hear more about your background, but I want to dive right in. And, the last show we were talking about apartments and how great they are. And now I hear you're into self-storage and you've started a fund and, catch us up about, some changes that's happened recently, and we'll get into why and those details.
Okay, can you promise you won't tell my wife I jumped from multifamily to self-storage and mobile home parks?
I won't tell her.
Okay, because I promised my wife 5 years ago when we had finished a Hyatt hotel in North Dakota and that was not successful, but we had another successful multifamily quasi hotel before that. I promised her, I am sticking with multifamily. I'm in multifamily, has amazing demographics. It's got the millennials. It's got the next generation behind them, Gen Z. It's got, immigrants. It's got baby boomers who are starting to rent more and more. Everything lines up for multifamily to be the perfect investment. And that's why I called the book that. And I still believe that, Whitney. In fact, somebody asked me this the other day, if I had $1 million to place somewhere and I had to leave it sitting for 100 years, like Warren Buffett, where would I put it? I would put it in multifamily because I really believe the apartments being built today will still be occupied by multifamily tenants in 100 years. But the problem is right now, too many people read my book. I'm kidding. Seriously, too many people have come up with the same idea. So many people are rushing into multifamily. We've got international money coming in, self-directed IRA money coming in, self-directed 401k money coming in. You've got new people coming in. That's new gurus, people who weren't around through the pain of the last recession, and they don't really see that they're overpaying. We've got wolves in sheep's clothing telling people it's okay to dramatically overpay for multifamily. We have got a record number of 1031 exchange money coming in, all rushing at multifamily, in addition to REITs, which are coming in from the coasts into the middle of America, competing with us in small towns like Roanoke or Lynchburg or Lexington, Kentucky. So multifamily is the perfect investment, but it's just too perfect right now. It's overheated, and we decided about a year ago to expand our vision at Wellings Capital to self-storage and mobile home parks. And what we love about those is both of those are recession resistant. Both have done very well during the last downturn, and they've done well in the boom time since then. So that's kind of a quick overview where we've been. We've set up 2 different funds to allow our investors to have access to multifamily, self-storage, and mobile home parks.
Could you speak to what you said about being recession resistant and about those asset classes and why that is?
Yeah, absolutely. So think about mobile home parks. It costs anywhere from $5,000 to $12,000 to move a mobile home. And so there are a lot of, it's believed that only 1% of mobile home parks are owned by institutional investors. 99% are therefore by independent operators. A lot of those are mom and pops. And if you can find the right one, acquire that mobile home park, and start upgrading, the park, upgrading the office, upgrading the experience, you can add a lot of value. I never really would have thought you could add value to a mobile home park, but you can also raise rents. A lot of the mom and pop owners might have 100, 300 lots, and they haven't raised rents in many, many years, and they're way below the market. Well, if you raise rents, and again, I'm not talking about in an unethical way, but if you raise rents to the market value, people are probably not going to spend $5,000 or even 10 or 12 for a double wide to move it down the street to save $30 or $40 a month. It's probably not going to happen. And every mobile home park operator I've talked to has said this. And so you can raise the rents to a reasonable level. And it's the only asset class I know of, Whitney, where the supply is actually diminishing and the demand is the same or increasing every year. There's 10,000 people a day turning 65 in the US, and 1 in 3 have zero saved for retirement. 1 in 2 have less than 10,000 saved for retirement. A lot of them do, 60%, have home equity though. And a lot of those people are willing to trade their home equity to get a mobile home and move into a mobile home park and now have $250 to $500 a month in lot rent. And they can greatly decrease their costs and go on to Social Security as they ride off into the sunset. So that's mobile home parks. Self-storage. Now think about it. In great times, when people are crowding the cash registers at Walmart or jamming the checkout at Amazon, they're buying stuff and they need a place to put that stuff. Also, baby boomers and even millennials now are losing their parents, and there's all of my wife and my parents are gone. There's a lot of antiques and heirlooms and things we don't want to get rid of, but we don't have room for it. Places like Florida, Texas, and California don't have basements typically. So they need a place to put their stuff. Their attics are too hot in places like Florida. So they need a place to put their stuff. And in bad times, people are downsizing from, say, a 4,000 square foot home to a 2,000 or a 2,000 square foot home to an apartment. And when they do that, for a relatively small amount of money, they can store their stuff at a self-storage facility. Now, if I had an apartment and I was renting it to you, Whitney, for $1,000 a month and I raised your rent by 6%, you might move for $60 a month, especially considering you're going to be there for years to come. You've chosen that life. But if I raise your $100 a month self-storage unit by 6%, you're probably not going to rent a U-Haul, get your friends together, get all sweaty to move your stuff down the street to save $6 a month. And so, especially when you think as a tenant, you're probably not going to be there more than a few more months anyway, which is what many, many tenants think. And of course, as it dings their credit card month after month, year after year, they're often there a lot longer than they planned. So self-storage tenants are sticky, and I don't mean they have Velcro suits on. They're sticky, they stay, and so do mobile home park tenants through thick and thin.
So if across the board, like everything was the same as far as the number of people looking for that asset class, say on a percentage per the size of the asset class or number of those units across the country, would you still, what class would you choose then? Now that you're experienced with each one, let's say, the field is equal on all of them.
Out of all those three?
Yes.
I would choose a very specific value add formula with self-storage. And if your time permits, I'll tell you what that is.
Let's hear it.
All right. So there are 53,000 self-storage facilities in the country. They're growing by 2,000 this year. So I guess they'll be at, well, you do the math. No, it's 55,000. It was a joke. But seriously, 55,000 self-storage facilities in the country. It's believed that about 40,000 are operated by independent operators like mom and pops.
Wow.
Okay. And so there used to be a mantra, if you build it, they will come. And it was true because self-storage was new in the 70s and the 80s, and people could just build a self-storage facility on a field near town and it would fill up. And so these operators operated these like mom and pops. They operated these like a passive piece of real estate. And that was the draw for me. In 1999, I almost built a self-storage facility near a little town called Rocky Mount, Virginia. And I, had the land available, and I thought about it, but then I thought, oh man, somebody else could throw in another 500 units right next door, and I couldn't really stop them. And I'm glad I didn't do it, because I didn't know I would have been one of those mom and pops that needed to be acquired. But anyway, these mom and pop operators often don't have websites. They often build it for a fraction of today's value. They're getting a massive return on investment. They have a part-time person working a phone, and they don't have a showroom. They don't do a lot of marketing. They don't raise their rents. There's all kinds of things they don't do that a professional operator could do. So here's the opportunity, Whitney, and this, like I said, of all these asset classes, this is what I would do. I would go in and find a self-storage facility that's in the path of progress, but that's outdated, that is perhaps doesn't have a website, doesn't have great marketing, all these things, and maybe has some room to build additional units. I would acquire that. So number one, I would acquire from a mom and pop. They say you make money when you buy. Well, with this strategy, you make money when you buy, when you operate, and when you sell. So number one, I would acquire from a mom and pop. Number two, I would go in and change every policy and procedure that made sense. For example, I would add a really nice website. I would start looking for tenants who were not price sensitive. I would start culling off the tenants that were. I'd start raising rates to the market rent. I would start selling units individually to tenants based on their motivation, their income level, etc. In other words, we can get to know each tenant, and with Facebook and all the other tools we have out there, we can actually get to know these tenants. And we know if one comes from California and they're relocating and they're building a home and it's going to take them a year to build a home, well, they're not going to move. And we can raise their rates a little bit more than somebody else who's really price sensitive. So I would market that way. I would operate that way. I would add U-Haul, and that would, or Penske, and that would add $1,000 to $3,000 a month. I visited with one recently in Rockledge, Florida, that was saying that their revenue from U-Haul, their commissions alone were $5,000 a month. I would add U-Haul. I would add a showroom with locks, boxes, tape, and scissors for sale. I would add admin fees, late fees, and I would begin to really evaluate the demand in the market. A mom and pop owner just says, hey, we're out of 10 by 10, sorry. But a great operator prices the last one or two in a high demand unit size much higher. Yeah, we've got 10 by 10s, they're X, and they're higher than what we sold the one for last week. And I would additionally go in and evaluate what the sizes were that were in most demand, and then I would build more of that size. Or I would, this is just sheet metal and concrete, I would knock out some walls and reconfigure to get the sizes that were in the most demand. And that's what a professional operator does. And so I would operate well, and then I would plan to sell it to an institutional. In fact, I would do it with several in a region. I would bump them up to a professionally run operation. I would add units if I could, and then I would sell it to a REIT for a compressed cap rate. And so that is a long answer, but that's what I would do. And if you look at the value formula in commercial real estate versus the value formula for residential, you'll know why I would do it this way and why I would be in commercial real estate in general. Have we talked about the value formula before?
I don't remember.
You want to chat about that?
Sure.
Okay, great. So in residential real estate, almost everybody's owned a home or rented a home or had a single family rental or a duplex or a triplex. The value is based on the other homes in the neighborhood. So no matter how Chip and Joanna Gainish you are, no matter how beautiful you make the house, you're going to be limited by the other homes in the neighborhood. There was a guy named Jack Wormer. He and I upgraded a beautiful Cape Cod home on Signal Hill Road in Roanoke, Virginia, back in 2001, I think it was. And no matter how beautiful it was still limited by the declining neighborhood around it. We learned a hard lesson from that house, I'll tell you. But in commercial real estate, it's very different. The value, and you know this, Whitney, is based on the net operating income divided by the cap rate. So the net operating income is the free cash flow, basically the net income, not including debt service, that is thrown off by the operation of the property. Okay. Now the cap rate is the capitalization rate, or the rate of return that that type of asset in that geography at that time would bring. And a typical cap rate would be between 5 and 8%. Okay. So the basic rate of return investors expect on their investment. Okay. That's at the asset level. So if you can increase the numerator, the net operating income, and somehow compress the denominator, which is again the cap rate, you can dramatically increase investors' return. So here's an example. Let's say I bought a self-storage unit, back to the same example from the mom and pop. If I can increase the U-Haul income by, let's say, $1,000, $2,000, $3,000 a month, and I can increase rents by, say, 20%, which is kind of normal for buying from a mom and pop that hasn't really maximized rents. If I can add another building, let's say it's a climate controlled, beautiful building, I might be able to add, who knows how much, let's say another 20% to income. Of course, there's a cost to that. And then let's say I add locks, boxes, scissors, increase occupancy. And by the way, U-Haul alone, they say increases occupancy by 3 to 5% because people rent a truck. And then, of course, they often say, hey, I need a place to store this stuff while I'm at it. So all that stuff combined, let's say we increase the numerator by a 50%. Okay. So we go from, theoretically here, $100 to $150 in income. Okay. So we've increased it by 50%. Now, at the same time we did all that, we put in new fencing, new security, beautiful showroom, upgraded the marketing, upgraded to a first-class facility, and now we can compress the denominator from, let's say, theoretical 7% down to 5.5% when we sell to a REIT, because they're willing to pay a premium. Let's just say 6%. So the increase, the numerator went from 100 to 150. The denominator went from 7 to 6. That is an increased value appreciation to the property of 75%. Okay. That sounds really good. 75% appreciation just from making these changes and, finding the right type of buyer. But it's much better than 75% because we forgot the leverage. The 75% at the asset value is leveraged by debt. And so let's say we do a fairly conservative 60% loan to value ratio. 60% loan on that means you're effectively multiplying your equity by 2.5x. You can do the math, but it's 2.5x. So that's taking the appreciation from 75% at the asset level to 187% to the equity. 187% increase in equity just from making these changes. And none of those that I said were, unrealistic or that hard, but you can't do that in a year. It might take 2.5, 3.5 years. Let's say it takes 3 years. So 187% return divided by 3 years, that's 62% ROI per year. And that doesn't include the principal pay down, if any, and that doesn't include the income thrown off annually by the facility, which might be 4, 5, 6, 8, 10%. So that's about 70% annual ROI. And by the way, that was a real example because one of the operators our fund is investing with has done that, an average of about 70% ROI to its investors over the last 19 deals on average. So you can see why Wellings Capital loves this value add self-storage strategy.
Are you tired of answering emails from investors about when they'll receive their K-1s? Let the real estate CPA handle the accounting and taxes on your next syndication, and they'll file your tax returns by March 15th so you can get your K-1s to your investors by the individual filing deadline on April 15th. Not only will this reduce headaches, but it will help you retain investors over the long term by improving investor experience. The Real Estate CPA is now offering a special virtual workshop to the listeners of the Real Estate Syndication Show on how to answer tax-related questions from your investors. Learn more today by visiting therealestatecpa.com/syndication. That was going to be my next question. Are you finding operators who are doing this and are doing all these improvements like you're talking about?
Yeah, absolutely. We've found 2 or 3 operators. There's probably dozens out there who are able to do it. Like I said, there are 40,000 potential facilities. Now, many of those are too small. They're not in the path of growth or in small towns, but a lot of those are potential targets, like one we just invested in South Carolina, and another one I can tell you about in Reno if you have a moment.
So, right. I'd like to know, we don't have a ton of time left. However, I'd like to know a little about, your fund, why you started a fund, and, maybe the listener who is thinking about starting a fund and why they would go down that path or why they wouldn't.
Yeah. So, the funds have the same, a fund investor gets a K-1 and not a 1099. Now, if you're an investor with a type of asset class that gives you a 1099, you might not be getting all the depreciation that a direct owner of real estate does. But a fund or basically investing through an LLC gives you all the depreciation, all the amazing tax write-offs that real estate investors get, especially with the new Tax Reform Act. Pretty stunning, some of the new write-off potential. But a fund gets all those. But it also means investors with us, they get, number one, they get diversification. They get to diversify their investments across several different operators, geographies, and quite a few different assets. So that's one beautiful thing about a fund. Secondly, they're getting our due diligence. We're spending a whole lot of time doing due diligence on these operators, these geographies. We've turned down far more than we've accepted. And we're basically getting... we're trying to take the emotion out of it that a lot of investors struggle with when they really like an operator and they see big numbers, like some of the numbers I threw around. Some of those operators are people we wouldn't invest with, even though the numbers look good. And so we are adding the due diligence, the diversification. We're giving the same benefits as investing directly. And one more thing, we've got a special deal with most of these operators that allow us to get a bonus or a premium on our investment because we're bringing them, perhaps 30, 40, 50% of their equity. So we're getting a better deal than a retail investor. And of course, our investors are getting the advantage of that.
Interesting. So obviously I'm raising capital for different deals, but I can see where an investor in your fund, like you said, are much more diversified as opposed to investing in one specific deal that I'm working on or that I'm partnering with another sponsor on.
It's possible. Yeah. I don't know the deals that you have, but yeah, I mean, Whitney, I believe that you're part of groups that are also getting great, those same type of premiums, but it's a very quick example. A retail investor who goes to one of our operators might get an 8% preferred return and a 50-50 split and still get a very nice return. But if they invest through us, they're part of a deal that gives them up to a 10% preferred return, and instead of 50-50, a 70-30 split. Now, what does that do? That basically offsets our fees. I'm not saying they're going to make a whole lot more, but they're going to get the diversification, the due diligence, and they get to work with me. No, I'm kidding on that, but that was totally wrong. But anyway, we really do enjoy our investors, and we do have some fun here. So anyway.
So what's, as far as the fund specifically, and we'll have to move on, hardest thing about setting up a fund and how do I know I'm ready to do that?
Hardest thing about setting up a fund, I was really surprised. I hate to let the cat out of the bag here, but it wasn't any harder than setting up an individual LLC. I mean, it wasn't any harder than an individual syndication. The typical cost for setting up an individual syndication is between $10,000 and $17,000. And that includes a few $1,000 for state filing requirements. It's about the same for setting up a fund.
Paul, is there a way that you've recently improved your business that we could all apply to ours?
We had one or two investors who came to us before we were ready. And this is not with the fund. This was actually about a year and a half ago, when we were doing a multifamily deal. And we had so much hassle, so much trouble getting the wire instructions to them, in these days of, all the wire fraud and all that. We had so much hassle just getting the money, the documents signed, everything initialed, everything, all done right, that we set up a portal. And we spent quite a bit of money, of our own money, to do this, but we set up a portal with a company that allows our investors the most incredibly simple, user-friendly experience you can imagine. And so that is one of the best things we've done. And we set that up with CrowdStreet, although there are a lot of other operators out there who do a great job. This is a private label. They're using our colors, our fonts, our logo, and we love it.
Great. Yeah, CrowdStreet. I haven't done a demo with them, but I've done a demo with most of the other companies like them, or portals. So Paul, one thing that's contributed to your success?
Learning to say no. I spent most of my first, 20 years, I guess, as an entrepreneur. I guess you could call it chasing shiny objects, but I mean, my default was to say yes. If everything looked good and I really liked the person, I would say yes. And now my default by far is no. And we're learning to say no more and more. And even people we really like and we want to do business with, they've got to check the boxes. And it's made it slow going, and we've been slow to grow, but I think it's worth it. And I think in the next 10 years or so, our investors are going to thank us for that.
And what's something you're excited about right now for Wellings and in the future?
I think I might have talked about this before, but somebody last night, one of my kids at bedtime says, well, another day, another week starting, it's Monday. I said, yeah, I'm excited. I'm another day closer to setting slaves free, because Wellings Capital is, Whitney, I don't know if you've heard, but you probably have. Human trafficking is appalling. If I was alive in the 1860s, I want to believe I'd be an abolitionist fighting for the freedom of slaves. Or if I was an adult in the 1960s, I want to believe I'd be fighting for civil rights. Well, human trafficking is a civil right that's been ripped away from about up to 40 million people who have been enslaved around the world. Did you know, if you took the record, not the average, but the record profits of Nike, General Motors, Starbucks, and Apple, the record profits, added those together, doubled that number. That's less than the estimated annual revenues from human trafficking. It is a horrible thing. It's not making headlines, and it's not causing a civil war, but it is nevertheless one of the most grievous things. And it's happening right now on our watch. So Wellings Capital is passionate about getting the word out about this and fighting human trafficking and rescuing its victims.
I appreciate you sharing that, Paul. I also like to ask guests how they give back, and I assume that's it, or is there something else you would add?
No, I think that would be enough.
No, and is there a need in your business right now that you would like to let the listeners know about?
No, we just want to connect with accredited investors who would love to have diversification across several asset classes. Awesome.
Paul, and how can they get in touch with you?
You can just go to my website. It's wellingscapital.com. That's WELLINGS capital.com.
Great. Paul, thanks so much for your time today and being on the show. And I appreciate the listeners being with us today. I hope you all will connect with Paul, and also go to Life Bridge Capital and connect with me. Also go to the Real Estate Syndication Show on Facebook, so we can grow our business together and network with like-minded entrepreneurs. So have a great day, and we will talk to each of you tomorrow.
Thank you for listening to the Real Estate Syndication Show, brought to you by Life Bridge Capital. Life Bridge Capital works with investors nationwide to invest in real estate. while also donating 50% of its profits to assist parents who are committing to adoption. Life Bridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.